Hey, this is Chris, and in this video I'm going to be sharing how I would look at an active fund to work out whether I think it has a chance of outperforming over the long run. Now, to be clear, I don't invest in any active funds, and the reason is pretty simple. Very few of them are able to outperform over the long run. In Australia, it's about 14% over the last 15 years, and those funds are always changing. So you might get lucky and get one of those 14% one year and not be in the 14% in the future. It's a fleeting thing. Fund managers come and go. They don't survive a lot of the bad ones as well, so you don't actually see that in the data. However, if I were to pick an active fund, here are the three things I'd be looking for. So the first thing I'd be looking for is an ability to outperform over the long run. Now, statistically, we know in order to have enough data to see whether a fund manager's performance is due to skill and not luck, we need about 20 years of data. And that's to go through different market cycles, but also just statistically, because even based on chance, a good bunch of fund managers will outperform just randomly. To give you an example, if you had 100 people tossing coins, after one toss, you'd probably have around 50 that have done heads. After two tosses, you'd still have about 25 that had done heads. After another toss, it would be 12. And after another toss, it would be 6. So after 4 tosses of a coin, you're going to have 6 people that look like they're very good at tossing heads. But of course, we know that was all just due to chance. And funds management is very similar. Just due to chance, you'd expect that 6 out of 100 fund managers will consistently outperform over 4 years. And so that's why we need 20 years of data to be able to assess their performance. So the first thing I'd be looking for is a very, very long period of outperformance, because that would give you the confidence that it's actually due to skill and not luck. The other is to make sure that that's in different environments. Now, naturally, 20 years does cover different market environments, but what we actually see is a lot of fund managers do well when one particular style is doing well. So they're not actually giving you access to their great stock picking skills. They've just been lucky in latching onto the right style at the right time. That could be onto growth stocks or value stocks or tech stocks or some other style or factor trend. And so you want to be able to see how they've performed when different factors have done well at different periods in time. How have they done in a period where there's been deflation? How have they done well when markets are rising, when markets are falling? You want to have a look at all of those different periods to assess their performance. And the next one is fees. So over the long run, it's very difficult for funds to outperform, but if they do, you want to make sure that enough of their outperformance actually goes to you as the investor and the person that's providing the capital, and not just to them. Now, a lot of active funds charge a fee of something like 1 or 1.25% per year. It's very difficult over the long run to beat the market by that amount consistently. And so what you want to make sure of is that their fee is low enough to actually give you access to some of their outperformance. As a rule of thumb, I would actually be looking for active funds that are charging more like 0.5% per year, with the view that even the very best active funds out there can probably only beat the market by 1% a year over the long run. And so you want half of that to be going to you rather than all of it going to them. Otherwise, it completely defeats the whole purpose of investing into active funds, because all you're doing is funding a fantastic lifestyle for the fund manager who's monetizing the value of their skill. And the other final thing I'd be looking for is the way that they structure performance fees. So performance fees are one of the big killers when it comes to active investing, and that's because active fund managers often are very clever in how they structure the funds, and so they make money when they do well, and they don't have to give it back to you when they perform poorly. So what I'd be looking for is a fund manager that measures their outperformance over not just 1 year, but over multiple years. And then after a good period, if they've paid themselves a performance fee, they actually refund it, or at least there's what's called a high watermark if they underperform, so that you're not paying for the bad years and giving the money in the good years. And so they're the three things I'd be looking for: a very, very long-term track record. So statistically, you know you're actually onto a winner. Otherwise, in most cases, it's random chance. Low fees, where you're actually getting a good portion of the return they're generating over the market, and a performance fee that's fair and reflective of the fact that over periods of time, outperformance can happen just by chance, and you only really want to be paying for outperformance that's due to skill. And that's what I'd be looking for if I was selecting an active fund.